This video will discuss a case study where I recommended a Filipino couple I work with not to buy long-term care insurance. I'll cover the actual policies and the cost of insurance, hypothetical growth of their money, how getting a joint policy is better than buying two separate individual policies, and how their insurance benefits would be impacted if they chose to retire abroad, like back in the Philippines. They had many questions for the insurance agent as well, and I will share the answers with you in the end. Before we get started, I've been a financial advisor and certified financial planner for over a decade, but I am not your financial advisor. This video is for educational purposes only and not meant to be financial advice. So let's get started. The husband is 59 years old and the wife is 55. They're nearing retirement and wanted to evaluate how to best plan for future long-term care expenses. From what I've seen, primarily working with Asian Americans, the three main ways that Asian households plan to pay for long-term care are primarily, number one, self-funding, number two, insurance, and number three, asking their children for help with cost and or physical care. The good thing about my client's situation is that they have options. They have $2.5 million in retirement savings, so they can afford to pay for long-term care out of pocket. They make over $300,000 together, so they can afford to pay for insurance today. And they have a good relationship with their children if they need their help. This couple doesn't intend to rely on their children financially or physically for care. So we want to see if paying for it themselves in a few decades or buying insurance ahead of time would be a better financial choice. I asked my preferred insurance agent to evaluate long-term care insurance from a few insurance companies, and this is what my clients were presented with. They were presented with two insurance companies, Securian and Nationwide, and we focus on Nationwide because they had a cheaper shared care benefit. And this is a hybrid life insurance with long-term care riders available, and there are four main benefits. Number one is that the guaranteed long-term care benefits are available $6,000 per month for every insured person in year one, and there is an inflation adjustment of 3% compounded a year, and for example, at age 80, it turns into $11,162. This policy has a death benefit attached to it, so in case there is an acute injury that results in a quick death and there is no drawn-out long-term care needed, your beneficiaries will end up getting some money. Over 95% of people who end up buying long-term care insurance end up keeping it. But if you are in the minority of people who suddenly need your money back, you can cancel the policy after having paid in full and get some money back. And the final one is guaranteed paid up benefits. For example, the one we're looking at today has a 10 pay period where the client will end up paying for 10 years the same amount of premium. If they stop paying at year 5, they still get a reduced amount of $3,376 in monthly benefit per insured person. If they stop paying at year 7, they get just a little over $5,000. So here are some of the details for this policy that they were presented. The annual premium is $20,374. 10 pay means it's going to be paid over 10 years. So the total premium paid will be $203,740. So once the doctor clears the insured person as needing long-term care professionally, then the insurance company will pay $6,000 per month starting on day one. And there is a inflation rider on this of 3% compounded for the rest of their life. So for example, if they choose to move into a long-term care facility starting at age 80, then the benefit will grow to $11,162. The total available long-term care benefit as a pool that is available to be shared between the husband and wife is $640,000 starting on day one and grows to be $1.1 million, close to $1.2 million at age 80. Now you don't get all this money all at once. It's available at a certain speed at the monthly payment rate of $11,000. There is a lifetime benefit of 96 payments total, and it can be shared between the two. So one spouse can end up needing long-term care for only 6 months, and the widow may end up living longer, and she is entitled to 90 months worth of payments. And if they end up not needing any kind of long-term care and end up passing away unexpectedly quick, then their beneficiaries would be entitled to $216,000 in death benefit. Now, if they end up using all of the long-term care benefit available to them, it does reduce the death benefit amount, but even if they use it all up, they will still get $21,600 for the beneficiaries. Here's an illustration of this. You can ignore this left half of it and just look at this table. It is $576,000 in today's dollars without accounting for inflation. When the husband turns 80, the pool grows to be $1.1 million. So now we're looking at the illustration. There's a lot of information here. So pause if you need to take a look at this slowly. But what we're looking at here are the ages of the clients, 58 for the husband, 55 for the wife. This is their annual payment of $20,000. And they pay over 10 years for a total lifetime benefit of $203,000. And because this is a guaranteed premium product, the premium will be guaranteed to never go up. And also, once they pay for 10 years, they are done paying for the rest of their life. It does accumulate some cash value, but this is not designed to be an investment vehicle. Cash value will never grow at a good rate. So let's look at the death benefit. It is a flat $216,000. Even if they pass away at 100 years old, never needing long-term care, the beneficiaries will still get $216,000. And these are the before inflation numbers for total lifetime benefit and per month benefit. And this is where the inflation kicks in. So if they were to need long-term care starting in year 5, each of them would be entitled to $6,753. And that ends up being a pool of money of $720,000 that they can pull from. You'll see 2,000%. Obviously, if you only make one payment and end up being able to get $640,000 of money back, that is a fantastic return, but unrealistic. If you are someone who needs long-term care and you try to get insurance, you're just going to get denied. But what is likely to happen is in their late 70s or 80s, which is when they might be at the last few years of their life, that's maybe when they need long-term care. So let's take a look at the next page. So assuming at age 80, the cash value ends up growing, but it never catches up to the premium paid. At age 80, there is a cash value of $133,000 for a total premium of $203,000. Again, don't buy this for the cash value. The death benefit is still the same. The monthly benefit now is $11,162 for a total lifetime benefit of $1.1 million. And that results in an eternal rate of return of 8.89%. One additional benefit of this is that when the money is paid back out to you, it is not taxed. But there are risks with this. This is not a guaranteed rate of return. The first risk is not using all of the benefit. There is 8 years of combined benefits that they're entitled to, but if both of them only end up using 6 years worth of long-term care, then they won't end up getting all $1.1 million. So that would reduce their rate of return. If they end up living and needing care in their late 80s, then the rate of return drops to around 7%, which is still comparable to the kind of return you can expect from a moderate risk investment portfolio of low-cost stocks and bond index funds. But again, still have the risk of not using all of the benefit. But for clients who are very conservative with their money and are not willing to take risk with their investments, then this can be quite an attractive return. So out of the two policies, we like Nationwide more because they had a shared care policy. The 8 years worth of benefit is shared between the husband and wife. If the husband only ends up using 1 year, the wife can use the remaining 7 years. The insurance agent looked at two policies. Both policies provide $6,000 per month in benefit, and the Nationwide joint shared plan allows the benefit to be used by both spouses. And that's the only product I know of on the market like that. For Securian, they're also a competitive offering, but they only allow individual policies. So for the same $6,000 monthly benefit per person, there is a cap of 4 years. The husband is a little older, so his policy is more expensive at $11,699 paid over 10 years. And then the wife has an annual premium of $10,457 paid for 10 years. When you total it up, the joint care plan ends up being cheaper by about $1,780 per year. The individual policies, when you combine them, it ends up being $22,000. So buying the shared care plan offered an 8% discount relative to buying two separate policies. And one key point here is that they're both indemnity policies, meaning the insurance company is not going to ask for receipts. Once a doctor has cleared you for needing long-term care professionally, then the insurance will kick in and you will just get paid $6,000 per month. So we looked at another Nationwide policy. Everything is identical, $6,000 per month in benefit, 3% compounded growth in lifetime benefit, but we reduced the total lifetime combined pool to be 6 years worth instead of 8 years. The average stay for a male is about 2.5 years, and the average stay for a female in a long-term care facility is about 3 years. So when you have a shared pool, there may be a low likelihood that they would end up needing 8 years. So another option to reduce the premium is to lower the total benefit that the insurance company is liable to paying you. But I noticed here the premium reduced by a little bit, but not by a whole lot. So for the 8-year shared plan, it's $20,000, 374 multiplied by 10. Then the 6-year shared plan is $18,979. Because there is 2 years less benefit, there's 25% less total expected benefit, and they only give you a 6.8% discount in premium. And the reason the math works out this way is because there is a high likelihood that the insurance company will have to pay for 6 years worth of benefits. But for the additional final 2 years, there is a lower likelihood of it happening, so the additional risk is not that much more for the insurance company. But for those who are very concerned about those extreme cases where someone is in a memory care and ends up being physically healthy but mentally gone and needing long-term memory care for up to 10 years, the cost of buying the additional insurance may not be that much more expensive. And the final thing that my clients were worried about was what would happen if they moved to the Philippines to retire. The biggest obstacle that they would face is having their initial claim approved. Their doctor in the Philippines is going to have to review them and clear them for long-term care. Then the report would have to be sent back to the United States and reviewed by the insurance company. So that's the first problem. And the second problem is that the benefits would be reduced by a half. For Securian, they don't limit the duration of benefits. So each insured person who buys a Securian policy will end up still getting the 4 years worth of benefit, but instead of $6,000, now they only pay $3,000 for 4 years. And for Nationwide, the one we were interested in, the duration is cut in half, but the monthly max is still the same. So the same 8-year plan would pay $6,000 per month, but only for half of the time, 4 years total. So after sitting through the presentation, my clients had a lot of questions, and I included 6 of them for us to go over today. So the first one is, if they go with a 4-year term and pass away in 3 months after starting long-term care, what happens? So any money that has been paid out as a long-term care benefit reduces the death benefit dollar for dollar. So if they lived for 3 months and got $6,000 per month, then it would reduce their death benefit for the beneficiaries by $18,000. So they would end up with $198,000 in death benefit. Question number 2, if one of them passes away, does the death benefit pay out? Because this is a joint care plan, the death benefit of $216,000 is only paid out when both spouses pass away. Question number 3, when they need long-term care at age 82, do they get $6,000 or the after inflation value of $11,000? And the answer is they get the after inflation value of $11,842 at age 82. Question number 4, if the wife and the husband both need care at the same time, will the insurance company pay out? And the answer is yes. Both insured will get a monthly benefit, and that means if the individual benefit is $11,842 per month per person, and they both need long-term care, then the insurance company will pay a combined $23,684 for 4 years. Question number 5, what if they don't end up paying all 10 years of the premiums and want to stop? What happens with the insurance policy? And the good thing about this policy is that you keep what you've already paid. You will just call the insurance company and say, I will take a fully paid up policy and get a reduced benefit. And question number 6, can we just pay it all now, all in one payment? And it's called a single pay plan, and you will have a lower total premium than a 10-year pay plan. We didn't look at it for this particular client, but when I looked at it for another client for a similar nationwide insurance policy, the premium deduction was a 17 discount for paying all of it upfront versus paying it over 10 years. So ultimately, I recommended my clients not to get long-term care insurance because number 1, the growth of their money, assuming that they get all of the benefit back and assuming that they live 8 years or longer in a long-term care facility, the returns are still lower than the stock market on an after-tax basis, assuming that they start after age 80. Secondly, there are a lot of reasons that the returns will end up being less. If they don't end up living in the long-term care facility for 8 years or more, the returns are going to be lower. If they choose to retire abroad, their benefits are going to be cut by half. So it made no sense to recommend this particular client to get long-term care insurance. In the end, reviewing the cost of insurance proved to be a good exercise. It removes the potential for future regret that might come up if they were to pay for long-term care out of pocket, wondering whether they would have been better off having bought an insurance policy today. As a planner helping my clients, we know we need to have a separate investment account earmarked for long-term care expenses down the road. If you have questions, leave them in the comment section down below and I'll do my best to help. Hope you learned something today, and I wish you the best.